Good morning, viewers, and welcome to our podcast, Impact and Insight. In this episode, we shall be discussing Section 33 that has to do with chargeable gains in the Nigerian Tax Act 2025. To discuss this with me in the studio is Eunice Igwe Bernard, a fellow Chartered Institute of Taxation, a chartered accountant with over 10 years experience in tax advisory, regulatory compliance, and financial strategy. Eunice Igwe is a tax manager with SIAO Partners, a leading indigenous financial firm that delivers financial services.
Correct.
Thank you for coming, Eunice.
Thank you for having me.
Section 33 of the Nigerian Tax Act has to do with chargeable gains, which is a replacement of the capital gains tax in the previous law. What's your take on that?
Thank you very much for that question. Now, Section 33, like you rightly said, is the section on the new Nigerian Tax Act that deals with chargeable gains. This simply means that it has brought awareness to gains arising from disposal of shares in the market, and it has made it part of the chargeable gains framework in Nigeria, as it wasn't like that previously. What this has done is it has made every investor in the Nigerian exchange aware of the fact when I sell shares at a profit, at what point does the taxman come in? So this section has actually brought things to the limelight, okay, and made things that were hitherto invisible visible. It has made it such that chargeable gains or disposal of shares is not totally taxable, but neither is it an invisible transaction. That's the summary of what Section 33 has done.
Okay. Well, what should an investor in the stock exchange buying and selling of shares, why should they care about this particular section?
It's like asking a farmer why he should care whether it rains or it doesn't rain. So every tax-aware person now knows that when you want to trade, when you want to sell off your shares on the Nigerian Stock Exchange, there are things you should be aware of. Okay. So one of the things you should be aware of is that not all my share disposal is taxable, right? Okay. So it has made it that you are aware of a threshold. Section 33, not just Section 33 as a standalone, mind you. Section 33 is subsumed in the section that has to do, in the chapter that has to do with chargeable gains. So when we talk about why
I know it goes up to Section 34 up to Section 49.
Yes.
Okay.
When it comes to assets, land, yes. So as an investor, why should I care? Now, if I'm an investor, you have to now ask me, am I a retail investor or a wholesale investor? Now, if I'm a small-time investor, why should I care about Section 33? Section 33-34 talks about the threshold.
Okay.
What is chargeable? Is it my whole sales process that is chargeable? It brings a threshold. So if you are disposing of shares in any 12 consecutive months, and that share is within the shares disposal proceed is 150 million or less, you don't have anything to do with the taxman. Okay. And if the gain from that disposal is 10 million naira or less, you have no business to do with the taxman. Okay. And even where the share proceeds is above 150 million naira aggregate in any 12 months, and you reinvest that proceeds into the same company or into another Nigerian company, you have no business to do with the taxman. Or peradventure, if those you share, there's a share transfer within the regulated security market.
Yeah.
Neither do you have any business with the taxman. So with these three exemptions, it makes me aware as an investor what I have to do when I want to dispose my shares. So that's why it's very important for anybody investing in the stock exchange to know what will happen at my exit strategy.
Okay. Okay. The exemptions that you clearly stated is a replacement of the rollover relief in the previous law. Right?
Correct.
Okay. But I'm aware now that probably this are some of the concerns of small investors, because under the previous law, the computation for capital gain tax is 10%.
Yes.
That's the rate. But
Flat.
that is gone now.
Yep.
So what is it? Can you take us through how do you the computation now? Because it has to be added back as income and then taxed at 30%.
For a company.
The rate has gone up.
Yes, for a company.
Okay, what?
For a large company. Okay, you're very correct. Now, when you're an investor in the stock exchange market, okay, and you dispose of shares, prior to now, in fact, prior to the Finance Act 2021, there was nothing like CGT on shares. But from the Finance Act 2021 to 2025, before the Nigerian tax law came into effect, we had the CGT pegged at 10%. And this 10% meant that both companies, anybody, is just 10%. But with this new tax act, if I'm a large company, we have a threshold for a large company. If I'm a large company and I dispose of shares, that means my share proceeds, the gain, forms part of my income tax computation and is now chargeable to tax at the rate large companies, big companies, we now have big companies and small companies, at the rate big companies are charged to tax, which is 30%. But if I'm a small company, my tax rate is 0%. So it doesn't, it doesn't come into play. Then if I'm an individual and I dispose, my chargeable gain is now treated as my individual income and is now chargeable at the rate of the pay as you earn. That's the PIT rate.
Okay.
Which is 800,000 first stage exempt.
Okay.
Graduating.
Okay, because I need to ask that question because that have really thrown up a little bit of controversy that it's going to discourage investment. And I would like to hear your opinion, though you've explained this now to our viewers, but I would like to, what's your opinion with all this argument that bringing it under the computation for companies now, bringing it under computation, taking it as income and computing it normally at the rate of 30% for big companies, that it's going to affect inflow of investment in the capital market. You don't share that view at all?
No, I don't. In fact, the whole thing about this, the tax act, if you look at it critically, has been to charge tax on a progressive basis. Okay? If you're big, you're big. You're small, you're small. So if I'm a big company, for instance, you know that what is being charged is not my share disposal proceeds, is the gain. And that gain is a net gain, meaning that there are costs that have been incurred. Okay?
In the disposal of
in the disposal. Okay. And is those costs, by the time you take those costs into cognizance, you get to your net gain on disposal. And that is the net gain that comes under computation. Prior to now, it was 10%, which nobody had any problem with. But if you look at the new tax rate, by the time you put in all the allowable, I bet you the 30% being applied to your gain on disposal is minimal. So I'm not sure it's going to discourage investment, holistically speaking.
Okay. Now you talk of reinvestment, and assuming that you make a gain of maybe 20 million, and you are reinvesting 15 million. What happened to the balance of the 5 million?
What happens to the balance of the 5 million? First and foremost, the 20 million has exceeded the 10 million.
Yeah.
Then the aggregate, no matter what the aggregate proceeds for the year is, the other benchmark is that the 20 million has exceeded the 10 million. The 5 million is what is chargeable, becomes your chargeable gain.
No matter what you do, if you do not reinvest the entire
If you
gains,
do not reinvest,
whatever is
left over
will be charged.
Good.
But, oh,
Good.
That's fantastic. So, for an individual wanting to do some tax planning, now this an area of your expertise, wanting to do some tax planning and is looking towards this stock market, what would you advise him?
I'm going to give you the planning free of charge. But I'm obliged. Okay, so you want to do tax planning, you have to plan around the allowable. Okay. So you look at your threshold planning. Remember that the 150 million is aggregate over a 12-month period. You have to look at when you're doing your disposal. Okay, how many disposals would you want to do in a year? You could have a cutoff. You can have a cutoff to determine, okay, I'm not going to exceed this. It has to go to the next year. Okay. You also have to do proper planning around your cost. We always have this challenge. We don't keep proper record. And there are costs associated with your disposal. You can't just wake up and sell. There are costs associated. By the time you put in your cost, this cost doesn't just end at the stockbroker's cost. There are other costs that are associated with the sale, which are all allowable. So you look at your cost planning, you look at the threshold planning, and then you also look at, do I have a connected party in this transaction? Because connected parties, that's related parties, if you have such, remember that the taxman has the right to reclassify such transaction if they are sure that those transactions are not transparent and do not pass.
Arm's length transaction.
Yes, arm's length,
Artificial
yes.
transaction. Okay.
So you could do your planning around this.
Okay. Now, we're looking at, again, the issue of owning foreign shares and disposal of foreign shares as a Nigerian. What impact or effect will this law have on this individual?
That's a non-resident.
A non-resident, yeah.
Okay. Very, 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 very good loophole that the Fiscal Reform Committee looked at. Okay. So what the act is saying is that as long as a non-resident is disposing of his shares within Nigeria, okay, once that threshold is met, he has those chargeable gains are liable to tax.
Okay.
Yes, they are liable to tax. So the essence of a non-resident just disposing of his shares and thinking proud to now, you know what this fiscal reform did was they looked at what was obtainable and what is obtainable in other climes and say, okay, we want Nigeria to also play on the global level.
Stage,
Yes, global stage. So in disposal of shares by a non-resident of shares in Nigeria is also liable to, when there is a gain, it's liable to capital, chargeable gain, no more capital gain. And this also talks about, the law does not expressly say anything about founders' shares or exiting of founder shares. So even founder shares, they also have to look at their planning, when they should exit the market, so as to reduce the impact of tax on their founder stake.
Oh, good. I've always have this belief that the best place to grow wealth is the capital market. I may be wrong, but you are here. When you look at, you give financial advice to your clients. I know I've read your CV. You do financial engagement with clients, and you're probably at a point with some startups, or you have young ones who want to come into the economic space to do something, invest money. What would you be advising? Are you going to advise them to go to the risk sector or going to the stock market area and invest in the capital market or money market?
That's a very tricky question in the sense that investment actually lies on the investor's personality. No matter the advice you give, the pros and the cons, the decision has to do with the investor. Is he risk averse? Is he a risk taker? Of course, the capital market in the last year has really grown in leaps and bounds, yes, undermining what people thought that the tax reform was going to dampen the transaction. Although there was some news towards this November, December that there was a lot of people calling for their investment because they weren't sure what the tax reform committee was saying. But I think when Mr. Oyedele came up on air and clarified that issue, it kind of brought the runs down.
Bring down the tempo.
Yes. So I would say the capital market is a better form of investment because it is sure, it grows steadily, is less likely to respond to instability. Of course, there might be waves in the market, but the thing about the waves in the capital market over the long run is that the chicken always comes back home to roost. So if you are patient, and you ask me for the young ones, not for you and I. So if you are patient as a young person, the chicken comes home to roost, and that investment you have made definitely in the capital market will give you returns of 30-40%. So I'll go for the capital market.
Okay. Follow up to that. If you're advising, do you advise trading, buying and selling, or buy and hold for the purposes of dividend?
Oh, you have come to dividend policy. You've come to dividend policy. Oh my. Okay, selling and holding, selling and buying. If it's for an individual, for me, let me speak as an advisor. One, if I'm giving you an advice, first and foremost, I want to know what is the purpose of investment. Okay. Are you investing because you have spare cash and you want to keep it tied down? Or are you investing because you are expecting a return and you don't mind how long this investment stays in the market? So if you are in the second category, I would definitely say buy and hold. No matter the waves, it will still come down. It will come back to roost. So buy and hold. But if you are in need for the short haul, and you're just strictly investment, is buy and sell. So you watch the market, you decide because of the greed factor. You tell yourself how many, if it's in stock exchange or if it's in buying of currency, crypto, you ask yourself, how many pips am I looking at? sorry, that's the best way I can do. How much am I looking at for this my investment to accelerate to? So if it rises like 5 naira, 10 naira, 20 naira, I'll sell. Then you're in need for the short haul, you buy and you sell. So everything depends on what was your intent of coming into the market.
Okay. So there shouldn't be fear going into that market, even with the new law in place. It's a wonderful time to go into the market. That's your advice.
Yes. In fact, if you look at countries that have high gains
Yeah.
on chargeable gains, you find out that the challenge is not the tax. What people are scared of, what investors are scared of, is actually the uncertainty. If there's so much uncertainty around my investment, I'd rather not invest. So investors are not scared of tax.
Oh.
They are only scared of uncertainty. But the tax law has come to stay. And if you look at it as an investor, there is no better time to invest as in now, especially if you're a retail investor. Because if you look at a retail investor, you look at a corporate investor, you'll find out that the corporate investor actually has more planning to do around his investment than the retail investor because of those thresholds.
Threshold.
Yes,
Okay.
that is there.
Now let me ask generally your opinion about the tax law which have taken effect January 1st. There have been up and down arguments here and there, but from an insider, a player, what is your general opinion about the reform?
The reform has come to stay. Nothing, generally, we are averse to change. We don't like change. We'll rather stick with the old that is not working than go with the new that would work. Why? Because we're not certain of how the change will play out. But this, with the tax reform, I can say, let me pick pay as you earn, for instance. I work.
Okay.
So during this week, we had a training for our staff on the deduction on their salary. And we juxtaposed it with what was happening in the old regime.
Okay.
And we found that when we showed it to them, they saw that, they've been hearing about this, undermining that they are professionals, but I mean, it doesn't concern me until you touch my salary. So when it was time for salary, it was like, this is what would be deducted. And they found out that actually under the new tax act, there are a lot of perks for them. Okay. So what is applicable on the individual level is also applicable on the corporate level. And we also need to play on the global stage. We need more foreign direct investment. And for these people to come in, for the capital market to also grow, there should be certainty. And this certainty should be backed up by law. Okay? So the new tax act, as a professional, although there are some uncertainties because the Nigeria Revenue Service are yet to roll out some guidelines, and yes, but we're certain that those guidelines are not going to be restrictive. We're certain that those guidelines would enhance the actualization and the intent of the tax reform committee that set about doing this, and the intent of the president as well, to see that we play on the global stage.
Oh, wonderful. Thank you. I think we are winding down now.
Thank you.
If you look at Section 34 of the Nigerian Tax Act, there is where it explains and expand their definition of assets. What do you have to say to that? We have intangible properties, we have digital visual assets, and a whole lot of kind of asset, though we've narrowed our discussion
to shares.
Would you like to say anything about these other assets?
Okay, I'll use the scope. Okay, we can see this. So in the new tax law, we're not just talking about I can move this to this movable property. The law is not talking about movable property, that if I sell this, assuming this is a share, if I sell this, that I'm liable to, if there's a gain, I'm liable to pay tax on that gain. The law also refers to intangible assets, digital assets, like ideas, okay? Those are intangibles, but they have values attached to them.
Yeah, okay.
So under this regime, this is the first time that intangibles are being brought and made visible. They are not you're not second guessing. It is expressly stated in the Tax Act what constitutes an intangible, what constitutes a digital or a virtual asset. And under the chargeable gain, once there's a disposal and there is a gain on it after you have taken cognizance of your cost, yes, it is chargeable. Okay.
Your parting shot now for my viewers.
Thank you very much for having me. I want to say, actually, even as a tax practitioner, when the new Tax Act came into view, a lot of us were skeptical. We're skeptical because this is Nigeria. You have policies, but what drives it is not just the policy, is the policy drivers are the human elements. And that was what made us skeptical. But as Nigerians, we have to believe in our country, Nigeria. This act must work. And for it to work, you and I have to contribute our part to it. You and I have to ensure that we're on the compliant side of the law. We do not want the law to come and whip us. So we have to be compliant. One of the ways you can be compliant is avoid ignorance. In this regime, ignorance is very expensive. Very expensive. So you're a corporate investor, you are a retail investor. It doesn't cost anything. Pick up your phone, call a consultant, ask, I want to take this move. I want to engage and to go into this transaction. What are my exposures? The law is not against tax planning. The law is against when you tax plan to avoid.
Tax avoidance.
Yes. So it's an avoidance. So the law is here to ensure that Nigeria becomes a better place. And the first point of call is pay your taxes.
Thank you very much, Eunice, for sharing your thoughts with us. I believe my viewers have enjoyed things that you've said, and they've gotten some takeaways from what you have delivered. It will help, because the essence of the program is to ensure that nobody is caught in the complication of implementation of the new Tax Act.
Yeah.
So thank you very much for coming.
Thank you for having me.
We truly appreciate you, and we look forward to having you in our subsequent episode.
My pleasure.
Thank you. So stay tuned, viewers. In our next episode, we shall be discussing another very interesting topic that will guide you and shape your investment thinking. Thank you very much.